I'm Brian Scott-Smith reporting for World Risk and Insurance News. In this program, Dr. Robert Hartwig from the Insurance Information Institute offers his perspective on recent developments in the world economy. The Eurozone debt crisis continues to impact the insurance industry as Greece votes on austerity measures, prompting widespread protests from Greek citizens. Moody's adjusts the sovereign debt ratings of EU countries affected by the euro crisis, and the United States warns that investments in Europe could affect US banks and other financial institutions. Health insurers are to cover birth control in the US as debate over the new health care legislation continues. And Barry Zaumer looks at Medicare fraud in another edition of Who Got Caught? This and more from the online video news network for the global insurance community. You're watching World Risk and Insurance News.
From our news bureaus around the globe, this is World Risk and Insurance News.
We begin with a look at the headlines affecting the global insurance community. Our top story, the euro debt crisis. The Greek parliament has approved an unpopular austerity bill which will result in large cuts in pensions, wages and a steep fall in overall living standards. The cuts are viewed as a prerequisite to secure a second $130 billion bailout in order to avoid default. After years of recession, high unemployment and lower wages, tens of thousands of people took to the streets in violent protest over the measures. Meanwhile, Moody's has adjusted the sovereign debt ratings of select EU countries, reflecting their susceptibility to the growing risks emanating from the Eurozone crisis. While Italy, Spain, Portugal, Malta, Slovakia and Slovenia were downgraded, France, Austria and the United Kingdom had the outlook on their AAA ratings changed to negative. Moody's pointed to the uncertainty for Europe's increasingly weak economic prospects and fragile market confidence. In the United States, the White House predicted the U.S. economy would fully recover from its economic recession over time. The administration sees a risk, however, coming from the European debt crisis, noting risks to investments held by U.S. banks and other financial institutions. Well, to help us make sense of all of this, we go to the NASDAQ market site in New York, where Marisa Christian welcomes Dr. Robert Hartwig, economist and president of the Insurance Information Institute.
Yes, Brian, I'm here with Dr. Robert Hartwig from the Insurance Information Institute. Welcome, Dr. Hartwig.
Glad to be here.
I'd like to start by talking about the global economy. Now, there are continued concerns about economic conditions and sovereign debt among European nations. What does this mean for the insurance industry?
We really have two major economies going here in the world right now, maybe even three. We've got the United States economy, which is recovering. We have the European economy, which is still suffering, and then the Asian economies, which are in fact decelerating, but still expanding. So to deal with the situation of Europe first, the reality is that the Europeans have made significant progress here, despite all the pictures that you see about rioting Greeks on the streets of Athens. And ultimately, I think a solution will be arrived upon, and I would not expect that this exposure would in any way affect the capacity or the pricing of insurance available on a global scale.
The U.S. appears to be cautiously optimistic about its own recovery. What key indicators do you look at, and how do they impact insurers?
Obviously, we like to focus on the employment numbers, which have been positive recently with 257,000 private sector jobs created in January. We're looking for more strong growth in the months ahead. When people are being hired, that means factories are running longer. It means means businesses of most sorts are in fact hiring people. So when we look at the energy sector, healthcare sector, even manufacturing today, transportation, whether it's trucks, marine or rail, these are all expanding. They're hiring people, but not only that, they're creating insurable exposures.
How has the budget stalemate in Congress affected both the U.S. economy and the insurance industry as a whole?
Well, Congress has worked very, very hard recently to try to destroy the American economy, quite frankly. But despite that, consumer sentiment has risen. We're seeing some expansion of business lending activity. Businesses are expanding, manufacturers are expanding. As the economy expands a little bit, insurers are going to be able to participate in it. An expanding economy floats all ships, including that of the insurance industry. So more things to insure. That is nothing but great news.
This might be a tough question, but what is your outlook for the year for the insurance industry?
Right. I'm looking for growth somewhere north of 4% for the property casualty insurance industry this year. I think that's going to top expectations, actually. I think we're going to see, hopefully, a reduction in catastrophe losses in 2012, though we really can't tell what Mother Nature is going to do at this point. But I think we'll see a better year than in 2011, but with some underlying deterioration but also insurers making some progress at getting some additional rate onto the top line that eventually will work its way down to the bottom line.
Thank you, Dr. Hartwig. Always informative.
Thank you.
Back to you, Brian.
If you'd like to see our entire interview with Dr. Hartwig, go to the RIN TV on-demand library. In healthcare news, birth control mandated under the new US healthcare legislation continues to be a hotly contested issue, with some religious institutions objecting to the mandatory coverage. Meanwhile, an Obama administration official said healthcare insurers would not be allowed to increase premiums, charge co-payments or deductibles to make up for the cost of contraceptives. America's health insurance plans issued a statement saying they are concerned about the precedent this proposed rule would set. Still, most in the industry do not expect free birth control to hurt profits of health insurers. The administration expects insurers will ultimately make up any initial costs by avoiding expenses associated with unintended pregnancies. And staying with healthcare, here's Barry Zalma with another edition of Who Got Caught, looking at Medicare fraud.
Every year, insurance fraud in the United States costs the insurance industry somewhere between $80 and $300 billion. Here is one such case, Medicare fraud. A Florida man used a stolen doctor's identification to falsely bill Medicare $5.6 million for treatments that were not needed nor provided. He was able to commit the fraud electronically, and he collected a total of $4 million over a period of years. During this time, he was never questioned by Medicare, and Medicare only reduced his bills by $1.6 million. They never checked to see if these services were actually being provided, or even if he was a doctor. Greed, however, finally received the attention of investigative agencies, and the Florida man was convicted and sentenced to 133 months in the federal prison. He had to forfeit $1.3 million he hadn't been able to spend yet and give the government his 42-foot yacht. Today, the U.S. Department of Justice has set up HEAT, an agency to catch these criminals. It has been successful in prosecuting people like the man from Florida and continues to go after those who commit insurance fraud. Thank you for watching.
If you missed previous editions of Who Got Caught with Barry Zalma, go to our on-demand library for a complete listing of prior programs. Well, that's all for this edition. I'm Brian Scott Smith reporting from New York. Join us next time for more world risk and insurance news here on RIN TV.